Welcome to this powerful guide that could completely change the way you trade. If you've ever entered a trade only to watch it go the other way, if you've exited early and missed massive profits, if you've taken trades that felt right but never worked out, then this is the video you've been waiting for. Today, I'll walk you through a complete beginner-friendly system that teaches you how to enter trades with precision, exit with confidence, place stop-loss, and take profit based on logic, not guesswork, and avoid the most damaging mistakes new traders make every day. Let's dive deep into the exact entry and exit strategy for beginners. Foundation of a great entry strategy. A great trade begins before you ever click the buy or sell button. It starts with understanding the context of the market. Here's what you must check first. 1. Market structure. Ask yourself, is the market trending or ranging? Are we seeing higher highs and higher lows an uptrend? Or lower highs and lower lows a downtrend? If you can't answer this clearly, don't take a trade. Trading without understanding structure is like sailing without a compass. Why this matters: your entry should align with the market's overall structure. You don't want to be buying in a strong downtrend or selling into a strong uptrend. 2. Key levels. Next, identify areas where price has reacted in the past, support and resistance levels. Trend lines, previous highs and lows, moving averages like the EMA 20 or EMA 50. Mark these levels before any trade. These act like magnets. Price often reacts at these zones. 3. Volume context optional but powerful. Check the volume. Is it increasing during a breakout? Is it fading near a resistance zone? Volume gives life to price. If price is moving but volume is weak, be cautious, it might be a trap. Now that you understand structure and levels, let's go to the most crucial part, the actual entry trigger. Entry triggers and timing. Let's now explore the most beginner-friendly yet powerful ways to enter a trade. Method 1. Candlestick confirmation. Price comes to your marked level. Don't jump in yet. Wait for confirmation like bullish engulfing, pin bar hammer or shooting star, morning star or evening star, inside bar breakout. This tells you, yes, buyers, sellers are stepping in. Enter after the confirmation candle closes. Not during, not before, but after. Why? Because candle confirmation reduces false signals and emotional decisions. Method 2. Breakout plus retest entry. Breakouts are powerful, but most beginners get trapped in fake breakouts. Here's a better way. 1. Wait for price to break a resistance or support. 2. Don't enter right away. Wait for a pullback retest. 3. If price pulls back to the broken level and rejects it with a strong candle, that's your entry. Breakout retest confirmation entry. This method filters out traps and gives you a low-risk entry point. Method 3. Indicator-based entry. For those who prefer indicators, here's a simple yet effective combo: EMA 20 or 54 trend direction. RSI for entry confirmation. Example: in an uptrend, price pulls back to the EMA, RSI is above 50, bullish candle forms. That's your buy signal. Always remember, indicators confirm your existing idea, they don't create it. How to place the perfect stop loss. You found the perfect entry. Great. But now comes the part that truly protects your account: stop loss placement. Many beginners ask, how many pips should I use as a stop loss? The real answer is it depends on the market structure, not a fixed pip number. Let's break this down. Method 1. Structure-based stop loss. This is the most reliable method. Here's how it works. If you're buying at a support level, place your stop loss just below the recent swing low. If you're selling at resistance, place the stop just above the recent swing high. Why? Because your trade idea becomes invalid only when that level breaks. Until then, the setup is still valid, even if price moves sideways for a while. This method adapts to the market. It's logical and smart. Method 2, confirmation candle-based stop. Another smart technique is to use the confirmation candle's wick. Example, you enter after a bullish engulfing candle. Place your stop loss slightly below the low of that candle. This makes sure you're only in the trade as long as the confirmation holds. If the market erases that signal, you exit. Simple and effective. The exit strategy: take profit planning. This is where money is made, your exit. A great entry without a solid exit plan will never lead to consistent profits. Let's explore the best exit strategies. Method 1. Fixed risk-reward ratio. This is the simplest and most popular method. Example, if your stop loss is 20 pips, aim for 40 or 60 pips profit. That gives you a 1 to 2 or 1 to 3 risk-reward ratio. Why this works: even if you win just 50% of your trades, you still make money. This keeps emotions out of your exits. Method 2, support and resistance targeting. Exit at the next logical level. If you bought from support, exit near next resistance. If you sold from resistance, exit near next support. This method makes sense because price tends to react at these areas. You can use multi-time frame analysis to find cleaner levels. Method 3. Trail your stop loss, secure profits. Trailing stop loss helps you ride the trend while locking in gains. Here's a method: once the trade moves in your favor, move your stop to break even. As new higher lows in uptrend or lower highs in downtrend form, trail the stop below or above those levels. This method works beautifully in trending markets. Just don't trail too tight. Give the trade some breathing room. Method 4. Exit on reversal signals. Sometimes you can exit early before your full target. If price shows signs of reversal, look for bearish engulfing if you're long, bullish engulfing if you're short. Divergence on RSI or MACD, momentum slowing down, volume dying. These signals can help you protect your profits and avoid giving back gains. Method 5. Partial exit plus trail. This is a hybrid method, perfect for intermediate traders. Here's how: close 50% of the trade at 1-to-1 risk reward. Let the rest run to the next level using a trailing stop. This allows you to lock in some profits early. Keep potential for larger move, risk is reduced, opportunity is kept alive. Most common mistakes in entry and exit and how to avoid them. Even with a solid strategy, beginners often make costly execution mistakes. Let's expose the most frequent ones and show you how to avoid them. Mistake number 1. Entering without confirmation. Many traders see price touch support and jump in immediately. But price can break through support too. Solution: always wait for confirmation, like a bullish engulfing candle, a pin bar, or at least rejection with wick and volume. No confirmation equals no trade. Mistake number 2. Using fixed stop loss and take profit. 20 pip SL and 40 pip TP sounds nice, but the market doesn't care about your numbers. What works today in EUR USD might destroy you in gold or NAS 100. Solution: place your stop loss based on structure or ATR. Take profits based on real levels or minimum risk reward. Mistake number 3. Getting in late, chasing the trade. Have you ever seen a big candle fly up and you jump in late, only to see price reverse? You got FOMO'd, fear of missing out. Most of the time, these are traps. Solution: let the candle close, wait for pullback. Let the market come to you. Mistake number 4. Emotionally closing trades early. You enter a perfect trade. It's running in your favor, but at plus 10 pips, you panic and close it. Then it flies another 50 pips. Solution: stick to your plan, use break-even levels, trail your stop, or at least exit partially. Don't let fear control you. Mistake number 5. Holding losses, cutting winners. This is the number 1 account killer. Many traders take profits quickly but hold on to losses, hoping it will reverse. Solution: reverse that psychology, let profits run, and cut losses quickly using pre-planned stop loss.